Building a discounted cash flow model used to take an analyst 2 to 3 days, pulling 10Ks, historical data inputs, building forecast, writing formulas, checking for errors, and formatting for review. Today, I am going to show you how to do the entire thing start to finish in under an hour using Claude as your modeling co-pilot. We are going to build a full DCF valuation for Apple with real numbers, real filings, and investment banking grade formatting. By the end of this video, you will know exactly how to write prompt, what inputs to feed in, and how to sanity check everything it gives you. Let's get started. Before we jump in, a quick word on why this works so well. A DCF model is really three things: structured financial data, a set of formulas connecting the data, and judgment calls regarding growth rates, discount rates, margins, and terminal value assumptions. Claude is strong at all three. It can read source documents like 10Ks and annual reports, build the Excel formulas correctly the first time, and critically explain its assumptions so you are not just trusting a black box. But remember this rule: you are still the analyst responsible for the output. Claude builds the engine. You steer the assumptions and review the output. That division of labor is what makes this fast and reliable. One quick note before we start: never paste confidential or client specific financial data into any AI tool without checking your firm's data policy first. For this demo, we are using Apple's public filings. All information here is publicly available. Step 1 happens before you even open Claude. Gather your source documents. For Apple, you have to go to Investor Relations and download last 2 to 3 years 10Ks or annual reports so that Claude can see the revenue and margin trends. We also need a source for risk-free rate, equity risk premium, and beta. I'll use Professor Damodharan's published datasets updated periodically. So the link to the file is provided in the description. Upload these directly into your Claude conversation, or if you are on Claude with Google Drive connected, you can pull them straight from there. Let me go to Claude and upload 2 years 10Ks and Professor Damodharan's WACC calculation input file. Having 2 to 3 years of filings matters a lot. It gives Claude enough historical patterns to build a defensible forecast instead of guessing from a single data point. Here's where most people get it wrong. They ask for too much in one vague prompt. Instead, be an analyst giving instructions to a very capable junior, specific and structured. Here's the prompt structure I use. Using the attached Apple 10K filings and current Damodharan data, build a full free cash flow to firm based DCF model for Apple in Excel. Include 5-year revenue and margin forecast built of historical trends, a WACC calculation using capital asset pricing model for cost of equity, a terminal value using the Gordon growth model, a sensitivity table on WACC and terminal growth rate, and an audit check tab. Use standard investment bank formatting, blue font for hard-coded inputs, black for formulas, green for cross-sheet links, no blank cells, no errors. Notice what's happening in that prompt. I am specifying the method, the structure, the formatting convention, and the quality bar all upfront. That's the difference between a rough draft and a client-ready file. So I'll run this prompt on Claude and will pause the video for some time till Claude generates a DCF model. Let's go back to Claude and see the DCF model. So we see that we have the Apple DCF model, which we will download and open. So here's the model. So it has the cover sheet, the historical, the revenue forecast, WACC calculations, PCA sensitivity, and it also has scenarios and then audit checks. So the model is well structured. Now Claude has built the model. So it's our responsibility to check whether the output from the model is appropriate or not. So we'll start looking at the historicals. So here we have the revenues for 2023 to 2025. So remember, we gave 2 years of annual reports for 10 Ks, and Claude has pulled the data for 3 years from this annual report. It also has pulled the balance sheet and cash flow statement. So select items of the cash flow statement. Now let's look at the revenue forecast. So revenue forecast is 15% for 2027, which basically declines to 5.5% for the fifth year. And here we also have the justification of why revenue growth is 15% for 2026. So it says iPhone 17 upgrade super cycle, AI-led services acceleration, consistent with sell-side FY 2026 revenue growth estimates reported July 2026. So it also is taking into account the quarterly reported numbers. Then we have the gross margins. So it has given the comments around why gross margins is 47% for 2026. We have the capex forecast, working capital requirements, etc. And then it has also given us the mid-year discount factor adjustment. Moving to the WACC calculations. So here the risk-free rate is 3.95%. It is taking it from Professor Damodaran's WACC sheet. We have the equity risk premium, the current share price. So it is also calculating the debt to equity. So debt is very less in Apple. So it's just 2% debt to equity ratio. The beta is 1.32 and the cost of equity is 9.86 and WACC is 9.74. Then we go to DCF valuation, where it starts with the free cash flows to firm and then does the discounting, calculates the terminal value. So terminal growth rate is 2.8%. So assumption is that long run nominal GDP growth proxy is 2.5 to 3%. So it's taken 2.8%. And then we have the enterprise value calculation. The debt is deducted, cash and cash equivalent is added to get the equity value, divided by number of equity shares to get the implied value per share. In sensitivity analysis, we have the sensitivity to WACC and the terminal growth rate. Then we move to scenarios. So this model has created 3 scenarios: bear case, base case, and bull case. I think there's some formatting issue over here. Let's convert it to percentages. So the scenarios are around gross margin. So base case gross margin is 48%. And what happens if the gross margin reduces to 46 in the bear case and increases to 50 in the bull case? WACC, so it has also taken WACC reduction for bull case and WACC increase for the bear case, and terminal growth rate between 2 to 4% depending on the scenario. And here we have the implied value per share by the scenarios. So $104 to $237 depending on the scenario. At the end, we have the audit checks. We had asked it to place certain audit checks in the model. So here it is. So it is asking whether the balance sheets are tying. So balance sheets are tying, whether gross margin is reasonable, revenue growth is positive, WACC is greater than the terminal growth rate, is it reasonable, terminal value as a percentage of enterprise value. So it is 72%, which generally is the case. Terminal value is high, cost of equity, okay, and what is the net working capital as a percentage of revenue? Is it consistent with 2025? So yes, it is consistent. So we have the audit checks over here, and the model has passed all the audit checks. So as analysts, if we want to do any modification, we should do the modifications in the forecast, assumptions, etc. before sharing this model with our client or before using this model for any purpose. And that's it. A full investment banking grade DCF model for Apple, built in a fraction of a usual time, with you controlling every assumption that matters. The workflow scales to any listed company. Gather the filings, write a structured prompt, review the forecast and WACC, check the sensitivity table, and always run the audit check before you trust the output. If you found this useful, hit subscribe. I am building out a full library of these AI assisted valuation workflows for finance professionals. Drop a comment if you'd like the next video to cover comparable company analysis or LBO modeling using Claude. See you in the next one.